Welcome to this in depth analysis of debt securities and banking contracts, key elements of commercial and financial law. These tools are essential for understanding the economic and legal dynamics that govern our system. Our goal is to explore their key characteristics, providing clear and professional guidance. We will focus specifically on bills of exchange, checks, and the most relevant banking contracts. This course is designed to provide a solid foundation of knowledge, essential for students, professionals, and industry practitioners. We will delve into their legal nature and practical functions. Credit instruments are essential documents embodying a right of credit. They grant the legitimate holder the right to exercise the rights stated therein. Their nature is intrinsically linked to the circulation of wealth. The credit right embedded in a security is transferable, allowing for the rapid and secure movement of assets. This feature makes them dynamic instruments in the financial landscape. They are specifically designed for circulation, facilitating commercial and financial transactions. The primary function of securities is to facilitate the efficient and secure transfer of money. They allow the movement of economic values without the need to physically move cash. Furthermore, they simplify the transfer of rights, making it easier to assign credit positions. In short, debt securities are designed to simplify commercial transactions. They reduce the risks and time associated with trade, promoting market efficiency. Their importance to the economic system is undeniable. The bill of exchange is a fundamental credit and payment instrument in commerce. It comes in two main forms, each with specific characteristics and functions. Understanding these distinctions is crucial for their correct use. The first form is the bill of exchange, which constitutes a payment order. In this context, the drawer is the person who orders the payment of a sum. The drawee is the person or entity who receives the payment order and is required to execute it. The beneficiary is the person to whom the sum indicated in the note is to be paid. A bill of exchange contains an unconditional order to pay a specific sum of money. This order cannot be subject to conditions. The second form is the promissory note, which represents a promise to pay. Here, the issuer is the person who promises to pay a specific amount. The beneficiary is the person to whom the promise is addressed and who will receive the payment. A promissory note contains an unconditional promise to pay a sum of money. Again, the promise cannot be tied to future or uncertain events. Both forms are credit and collateral instruments. To be valid, a bill of exchange, whether a draft or a promissory note, must meet specific formal requirements. First and foremost, it must contain the term bill of exchange within the context of the title. This indication is essential for its legal identification. It must also include an order or unconditional promise to pay a specific sum. The amount must be clearly stated in numbers and letters to avoid ambiguity. The date and place of issue are other essential elements. Finally, the bill of exchange must bear the debtor's signature, whether the drawer on the bill of exchange or the issuer on the promissory note. Failure to meet any of these requirements may compromise the validity of the instrument. Written form is a constitutive element. Bills of exchange are typically circulated through endorsement. The endorsement is a notation placed on the back of the instrument or on a sheet of paper attached to it, called an extension. It is signed by the endorser who transfers the right. The endorsement transfers the credit right embodied in the security from one party to another. The endorsee becomes the new legitimate holder and owner of the right. This mechanism facilitates the negotiability and liquidity of the security. There are different types of endorsement, such as the full endorsement, which indicates the name of the endorsee, and the blank endorsement, which transfers the title to the bearer. An endorsement is a unilateral act that produces transfer effects. The bill of exchange can be endorsed multiple times, allowing for a chain of transfers. Each endorser, unless otherwise specified, is jointly and severally liable for the payment of the note. This strengthens confidence in circulation. The endorsement is a key element that distinguishes the bill of exchange from other payment instruments. It enhances its function as a credit instrument and guarantee. Its regulation is rigorous to protect its holders. The check is another fundamental payment instrument, but it has distinct characteristics from the bill of exchange. Its nature is that of an unconditional demand payment order. This means it must be paid immediately upon presentation. A check is issued by a person called the drawer who has funds available at a bank. The drawer instructs the bank to pay a sum. The check is made out to a beneficiary who can be a natural person or a legal entity. The payment order is addressed to a bank, which acts as drawee. The bank is required to pay the check if the drawer has sufficient funds in its account. This is a prerequisite for the payment to be valid. A check requires the drawer to have available funds at the drawee's bank at the time of issue. Failure to have funds makes the check uncovered and may result in penalties for the drawer. Its primary function is as a means of payment. Checks must also meet specific formal requirements to be valid. They must contain the word check within the title. This wording is mandatory for identification purposes. It must contain an unconditional order to pay a specific amount. The amount must be clearly and unambiguously stated. The date and place of issue are essential for its validity. The drawer's signature is essential. Without it, the check is void. The drawee bank must be clearly indicated. Check circulation also occurs through endorsement, similar to a bill of exchange. The endorsement transfers the right to collect the amount indicated in the title. However, there are limitations on endorsements for large amounts. The key difference between a check and a promissory note lies in their payability. A check is payable on demand, meaning the payee can request payment immediately. A promissory note, on the other hand, can have a future maturity. This feature makes the check a more immediate payment instrument and less oriented towards long term credit. Its purpose is to replace cash in everyday transactions. The rules governing the check are designed to ensure the speed and security of payments. Banking contracts are the cornerstone of financial and credit activity. They are agreements between a bank and a customer, regulating the provision of a wide range of financial services. These contracts are essential to the functioning of the economic system. Banking contracts are legal instruments that govern the relationship between credit institutions and private individuals or businesses. They define mutual rights and obligations, ensuring transparency and certainty in transactions. They are strictly regulated to protect all parties. These agreements govern the provision of financial services, ranging from simple deposits to complex financing. Their diversity reflects the diverse needs of customers. They are the foundation of banking relationships. Among the most common and significant banking contracts are the deposit agreement, the credit line, and the bank advance. Each of these agreements addresses specific financial needs. Understanding them is essential for anyone working in the sector. In a deposit agreement, the customer entrusts a sum of money to the bank. The bank assumes the obligation to safeguard that sum and return it to the customer. This is one of the most common and basic banking contracts. The bank is obligated to return the deposited amount with or without interest, depending on the agreed upon terms. The deposit can be a savings account with interest or a current account with additional services. Refunds can occur at the customer's request or at a predetermined deadline. A credit line is a contract whereby the bank makes a sum of money available to the customer. This sum can be used by the customer for a fixed or indefinite period. It is a flexible form of financing. The customer has the option to use the available amount in full or in part according to their needs. Interest is calculated only on the portion of the credit actually used. This agreement offers liquidity and financial flexibility. A bank advance is a contract whereby the bank grants a loan to the customer. This loan is secured by a pledge on specific assets. These assets may be securities, goods, or other movable property. And the bank advances a sum of money to the customer, retaining a percentage for interest and fees. The value of the pledge must exceed the advance amount, acting as a guarantee for the bank. This agreement is useful for obtaining liquidity against movable assets. A bank advance is a form of secured credit that offers the bank greater security. It is often used by businesses requiring immediate liquidity. The rules governing pledges are central to this type of transaction. A thorough understanding of credit instruments and banking contracts is essential to understanding how the financial system works. These instruments are the cornerstones of modern economic relations. They ensure the fluidity and security of transactions. This understanding is crucial to the dynamics of commercial transactions both nationally and internationally. Their correct management and interpretation are essential to preventing disputes and optimizing operations. They are indispensable tools for every economic operator. Ultimately, debt securities and banking contracts contribute significantly to the circulation of wealth and economic development. They facilitate trade, promote investment, and support business growth. Their evolution continues to shape the global financial landscape.